Hey everyone, welcome back to the channel. Most investors lose money because they buy stories instead of studying the numbers. But behind every stock, there is a set of numbers that tells you how strong the business really is. I'm going to talk about numbers that really matters. And once you understand how they connect, you'll see the whole system. Let's go through them one by one. Market cap is the company's total value in the market. It's the share price multiplied by the number of the shares that exist. If a company trades at $100 and has 1 billion shares, its market cap is $100 billion. That number tells you the company's size, stability, and how much attention it gets. Large cap companies above 100 billion move slowly because they're already dominant in their markets. Mid caps around 10 to 50 billion still have a room to grow but attract steady coverage. And small caps under $2 billion move sharply, high risk, high potential. Market cap is just the starting point. Before you look at the profit and growth, you need to know how the scale of the business you are evaluating. Here is the market cap of some of the popular companies like Google, Nvidia, Apple, and Amazon, and how they compare with each other. Next up is free cash flow. Free cash flow is what's left after a company pays every expense: salaries, supplies, taxes, and maintenance. It's the money the company actually keeps. This is the cash available to expand, pay dividends, reduce debt, and buy back shares. When free cash flow is consistent, positive, company controls its future. When it's negative, the company depends on borrowing or issuing new shares just to survive in the market. Free cash flow is what turns counting profits into real and usable money. It's the foundation of every decision management can make. In order to find the cash flow, you can head over to my app, select the stocks you want and the time period. You'll be able to see the cash flow of every stock quarter by quarter. Now let's talk about earning per share, also called EPS. It's the total profit divided by the number of shares. If EPS grows year after year, that means company's profitability per share is rising, either because the earnings are increasing or because the company is buying back the stocks. This growth is the clearest sign that management is creating value for shareholders. A company's growing EPS by 10% or more each year usually has a strong pricing power, controlled cost, and competitive advantage. No EPS growth means profits are flat. Falling EPS means business is shrinking or getting diluted. EPS growth is the heartbeat of value creation for a company. Let's look at some of the EPS of the tech stocks in the market. Next up is price to earning, or also called PE ratio. It shows how much investors are willing to pay for $1 of company's earning. A PE ratio of 10 means the market values the company at 10 times its annual earnings. A PE of 30 means the investors are paying 30 times, expecting higher future growth. Low PE ratio often means the market expects slow growth or sees risk in the particular stock. High PE ratio means investors are pricing the strong future performance of the stock. Neither is good or bad on its own. Context matter. Always compare a company's PE ratio to its own 5-year average or to the others in the same industry. That's how you know whether the stock is undervalued or overpriced. For example, here's the PE ratio of Google and Amazon when compared. Next up is dividend yield or payout ratio. Dividend yield shows how much cash return investor receives each year as a percentage of the stock price. If a stock trades at $100, pays $3 per year as a dividend, the yield would be 3%. The payout ratio shows what portion of the profit company distribute as dividend. A 40% payout means 40 cents of every dollar in profit is paid to the shareholders, and 60 cents is retained for the growth. A stable payout ratio under 60 is healthy. It means company can maintain dividends even in the weaker years. When the payout ratio rises above 80%, the dividend becomes fragile. If the profit falls, the payout gets cut, stock usually drops. Consistent dividend growth over the time is a mark of financial discipline and steady cash flow. For example, Coca-Cola, ticker symbol KO, has a dividend yield of 2.89%, that is over $2.04, and payout ratio of around 67%. Now let's take a look at how these numbers connect with each other. All 5 numbers are linked. Free cash flow is the starting point. It funds everything else. When a company generates strong cash flow, it can reinvest to grow profits, which drives up EPS. As EPS rises, investors can gain confidence and are willing to pay higher PE ratio, which pushes the market cap higher. Steady cash flows are also supports dividend, rewarding shareholders and attracting long-term investors who stabilizes the stock. When the cycle works, the company becomes stronger every year. Cash flow fuels growth, growth improves earning, valuation expands, shareholder return rises. But if one part weakens, cash flow drops, profit falls, dividend stretch too high, the chain breaks and the value starts to fall. Strong companies keep all 5 moving forward together. I hope this helps you to understand the important numbers for a stock. Thanks for watching, and if you found this breakdown useful, hit like and subscribe. Remember, numbers tell the truth, stories just make noise.